Welcome back to the ETF Inspector. It's Sunday, June 29th, a little after 1:30 in the afternoon, and this will be our video covering YieldMax funds, Ulti and LFGY. They are the weekly paying dividend funds. One is the Ultra Option Income Strategy Fund. The other is the Crypto Industry and Tech Portfolio Option Income Strategy Fund. And in this video, right, it's Sunday. We didn't have any trades to talk about. We'll be going over our week look ahead, or just to see where we're positioned with all the options going into the week, how far in or out of the money they are, how it looks compared to the current prices to see if we've got a good chance of winning those trades. And then also we will look at all the trades from the previous week and come up with a guesstimate for what the declaration will be this Wednesday. Funny thing about this Wednesday, not funny, but since there's a holiday week in it, we won't be actually collecting the distribution this week upcoming. It'll come the following week. Reminder, I'm on X. I'll let you know when videos are available and repost if YieldMax announces their distributions. Okay, ETF Inspector 1. I'll talk about that website in just a minute. And just for everybody that's reached out to me, I appreciate it. Got in a small accident, nothing major. We don't have to keep talking about it. I got rear-ended, sore neck and sore back, but that's the extent of it. So we don't have to keep going on about that. So let's see. Everybody likes distributions more. So we'll start off by talking about the trades and the guesstimate on the distributions first. So with Ulti, we had roughly, I think, about 430 trades throughout the week. So I've hidden everything except for this past week. So as we scroll through, it was a little over 400 trades. So we analyzed every one of them in the videos throughout the week. But then we total everything up and come up with our guesstimate. And we use some other things as well. So here's our trading week, Monday through Friday, this past week. Losing over 4 million, profiting 1.6 million, losing 3.3 million, losing 1.8, and losing 5. Comes to a loss of 8.6 million. So obviously we can't pay that out, right? The goal is to make income trading options and then pay out 90% of it. So they lost about 8 cents a share, so we can't do that. The backup is to pay the IV estimate of the underlyings. So what we do, the way we find that, that's where I said I'll talk about that website in a minute. I use Market Chameleon. Just for some reason, 30-day IVs aren't as easily accessible on every single finance page. So I like Market Chameleon. They keep this up to date. For example, this is Upstart, right? So I go through, look them all up, and update them. I only update them on the weekend before the estimate. I don't do this on a daily basis, looking up the changes in the IV each day. So went through that, went ahead and updated all of our IVs for the underlyings. All right, and then I take that and I multiply it by the weighting. So the weighting would be, in this case, AppLovin is 4.79% of our total holdings. So when you multiply the IV by the weighting and then you combine all of them throughout, you get a weighted average. Our weighted average went down from last week. We were in the 70s last week. We dropped down to just under 69% this week. So the way we get the IV estimate is multiplying the weighted average of the IVs by the closing price on Friday, which was $6.22. That came out to about 8 cents, 8.25 cents. But then we have other things to factor in. So the reason, there's a couple of different things to talk about. For starters, the reason that we lost money trading is because the stocks that we own increased in value so much. Overall, throughout the week, they increased by $18.5 million. So with that increase, that made increases in the NAV, right? So the higher that goes, the more we can afford to pay out from that, because as you see on X day, the share price starts lower by the amount that they are paying out. So if we run up, we can afford to pay some of that out and still have a nice share price, not having NAV erosion. So we've got a nice gain, so I'm going to use that to say I think it's going to be a little more. And then also, part of these losses, they're not necessarily trading losses. If you watch the Friday video, for example, let me scroll down here. I have taken away a lot of the calculations that were on the side. But just a small example, there was a couple of instances of this, but we'll just talk about these right here, easy to get to. So we sold out of VRT and Vertiv and Vistra Corp. And when we did, we closed the options associated with them. We closed the calls, we bought to close them, and we sold the puts that we had. But then from there, even though we sold the shares, we went ahead and opened a new trade on these. We bought call spreads. So those look like a loss. If you're familiar on the normal strategy, you sell the call, you collect the premium, and then you hope to keep it all. You hope it ends out of the money, it becomes worthless, and you close it for pennies on the dollar. But a debit spread is different. You are basically making an investment. They bought a call, and in this case, they bought calls in the money, well in the money, not even at the money. So they bought calls in the money and then sold calls out of the money. The reason to sell the call out of the money is to basically help finance the purchase. So if you wanted to buy the 115 straight up, so this is a July 11th 115, that costs $12.31. So the what you're doing is you're betting that it'll go at least $12.30 higher than 115 by expiration, in order for this to become worth more money. But that's a lot of money to put out. So a way to help finance that is to sell a further out of the money call to go along with that. So you collect some premium. So now that $12.31 per share didn't cost $12.31 per share because you collected $2.82. So now it was $9 and change, roughly $9.50 per share. So with that being said, now really your break-even point is 115 plus the 950, right, or 124.50, and you're good. And so that's your break-even. You keep on going. You make a profit, but then once you hit the 129, you will now start losing dollar for dollar on the sold call, as far as dollar for dollar that you're making on the purchased call. So it's an odd strategy. It's not something that they've done recently here. So we'll see how this works. But so this looks like a loss because you spent money, but they bought an option hoping to make money off of it in the future. So we'll see how this works out. In the meantime, right, it made it look like we took big losses, over $4 million just between these two stocks alone, on those two purchases. So with that being said, we've got some different types of transactions. We may have to adjust the way we calculate. I have been putting together a list of interview questions if I ever do get the chance to interview, where I can start asking about how they calculate different things with the IV, how they calculate profits and losses. But as of right now, I just kind of have to make assumptions to come up with these guesses. So we went up in value. Not all these losses are technically losses, and they've been liking to pay above the IV lately. So my guesstimate's 9. It may actually even be over 9 cents, but we'll see. I'm more about delivering information than making guesstimates. This is just a fun part you guys like. Okay, now let's take a look at how the stocks are doing. Although the overall weighted average decreased for the 30-day IV, we had some go up, some go down. I'm not going to go through individual ones. Let's just highlight some of the bigger ones that helped give us a nice high weighted average. We've got over 6% in AST Space Mobile, and they've got a 92.6% IV. That's helping. What are some other big ones? Ion Q's over 5% with an 82% IV. Oklo over 5% with a 98.5% IV. Those are nice. And I'm kind of scrolling through these slow, so if you wanted to just pause and get a better look at it. But I don't want to read line for line and drag the video out. Rigetti, I mean, it's only got 3.5% of the percentage of holdings, but 80.5 is a nice IV. New Scale's a new one we got into. We don't have very much compared to the other holdings, but it is a 95.3%er. That's really all the high 80s and 90s as far as IV. LFGY I think had one over well over 100%, so that was nice. But okay, so now we will take a look. This week coming up is a little different than usual, like we said, because there's only 3.5 trading days. So some of these are not closing this week; they are closing next week. So we'll have more time on those. The typical color coding, red being in the money. That'd be bad if you sold a call. You don't want it in the money because then it has value. You want it out of the money so that it becomes worthless. You want to sell something, collect money, it to become worthless, so then you get to keep that money. Yellow being 5% out of the money, that's in your favor, but it's close. And then green being greater than 5% out of the money. All right, we are lots of green. We like that. We like starting that way. AppLovin has 355 and 358 calls sold for the third, 6.3 and 7.1% out of the money. AST Space Mobile, they've got 56s for this week and 56s again for the following week. So they are each similarly 13.4% out of the money. So when I say these numbers, right, we just want this stock to trade below that call strike price in the week for us to win, to basically get to keep the maximum amount of premium. But we do want it to go up close to there so we can get the share value increase while still getting to keep the premium. That's the ideal situation. Coinbase, we've got 385 selected as a strike price. Those are almost 9% out of the money. First Solar, they've got some for this week, some for next week. 170s for this week, 167.50s for next week, 11.7 and 10% out of the money. And as I'm going through, I won't read the stock prices because it's actually going to be the same here and here since we're on the weekend. So this is Friday's close, but this is the updated holdings. I did forget to show you. When we go through and download the holdings, this is what it looks like. I take this and try to make it a little bit more visually pleasing for you guys, a little easier to understand. You don't need the outstanding shares 100 times. You don't need the net assets 100 times. I do my own weightings, and you don't need creation units. So I take this and turn it into this, plus add in the options in or out of the money percentages so that you've got a feel for how you want things to trade and how close or how dangerous they are. Okay, Robinhood, $88 strike price for this the third this week, almost 6% out of the money. But I said all that to here. These are your current price on the stock. Ion Q, 44 and 44.50 are the strike prices, 9 and 10.5% out of the money. This is LabU, right? There we go. Direxion Daily, S&P Biotech Bull, triple leveraged funds, $61 is the strike price, with it sitting at 57. That's 6.8% out of the money. Mara Holdings, just over 15. They chose 15.50 for this week and 16 for next week. They're 3 and 6% out of the money. Mobileye, this one's a little scary. They chose 18.50 with the stock at 18.34 on close on Friday, so they are less than 1% out of the money. We can't afford for the stock to go up 0.87% this week. MicroStrategy, 383.88. So as we know, they've got 390 and 392.50 selected for this week. But we know on any given day, MicroStrategy could either drop to 350, 360 pretty easily, or jump over 400, 405. So we don't like starting the week 1.5 and 2.25% out of the money, but it is what it is. Oklo, they have selected 65 for this week and 63 for next week as their call strike prices. They're 17.6 and 14% out of the money. Now those seem pretty far, but remember Oklo is our highest IV, so they've been jumping a lot lately. So we got to sell calls further out of the money, and that would make sense if you look. The IV of MicroStrategy is half that, not less than half of Oklo's, so that's why they're playing it closer to the money. Palantir, 141 and 144 strike prices selected, 7.8 and 10.1% out of the money. Currently at 130. Reddit has 155 selected for this week, 8.3% out of the money. Rigetti, 8.4% out of the money with $12. And then next week they have 12s as well. Those are obviously also 8.4% out of the money. Here's our first odd one. So we sold, if you watched Friday's video, we sold our shares of RH, but we decided to start a different option strategy on it. I chose blue here moving forward. If you've watched the videos before with like LFGY, MBTX, couldn't decide how to color it. So here's the thing. This is where they're trying to make money, so this is the one we're paying attention to. So again, I just talked about the Vertiv and Vistra Corp. This is an odd strategy. We'll see if it plays out well. I'm not familiar with it, but they bought a call in the money, like not at the money. The stock's at 190. They bought a 180, and they sold a 202.50. So selling that helped with collecting some premium to go towards the purchase. But now 180, we need this to increase, but not go beyond 202.50. At 202.50, we're capped with the maximum amount of profit. So we could basically make another 6% on that before we start being capped. So this one, we want this blue here to go in the money. So generally on this, I talked about in the money's red, signifying something bad, but in this case, in the money's good. That's why I chose blue, just to not confuse you with a red line here thinking it's bad. We want this to go up. Okay, I hope that made sense. I won't explain it every time, so just understand it's the same scenario for Vertiv and Vistra Corp. SMCI, this week, 49s and 52s, pretty evenly split with the contracts. Call it 3% and a little over 9% out of the money. New Scale, 11.2% out of the money with 42.50s. Tempest AI, stock ticker TEM, 6.73% out of the money, selecting 71 as their call strike price. TNA is another triple leveraged fund. For this week, we have 34s, and then for next week, we have 35s. Those are 1.7 and 4.3%. Don't like a triple leveraged fund selling only 1.7% out of the money, but I'm not a professional. I'm a guy in his basement that does this for fun, for free. But if you look, so here's another question that came up in comments, and now's a good time to put it. Somebody asked me how often are they protecting their shares percentage-wise compared to selling. So as you can see, they are basically selling 100%. So if we totaled up this 7,064 and this 2,047, you're going to get 9,111, which here you have it, 911,100. So if you could do this for 100 shares per contract, that knocks your 2 zeros off. You have a total of 9,111 contracts. So they sold the maximum amount. Now, protective puts, they bought the maximum amount. So they are always protecting their shares completely. So that I like the way Ulti trades. They seem to be positioned to be able to pay us out regardless of which way the market goes. But in this case, where they normally just buy the puts at the same quantity that they sell the calls, they broke this one up they bought puts at 27 and at 29. So breaking that up instead of just doing all 29 makes it a little cheaper. We bought some at 27. On the flip side, if we would have bought all at 27, we'd be less protected. The stock could lose a lot more before our protection kicks in. So it is what it is. I don't have a critique for it. It's just how they're deciding to spend and trade and protect the money. TQQQ, 81 is the strike price selected here, and 83. They are 0.5% in the money. So again, that's a triple leveraged fund that's starting in the money. So we cannot afford a green up week next week, or else this will be pretty expensive to close. Tesla Corp, or Tesla Inc. Sorry, 250 contracts. What I started to say at 335 and 340 are the two strike prices. A little over 3 times as many at the 340. All for this week, 3.5% and 5% out of the money. Looks like I missed one here because negative should not be read. Okay, Upstart is the last holding. We've got 66 selected as the call strike price that was sold. They're 4% out of the money. Now we have those last two. We sold the shares of Vertiv and Vistra Corp, but we still have this debit call spread that started in the money. As you can see, stocks at 127, they bought 115s. Stocks at 195, they bought 170s. This one's particularly strange. So I don't understand this one at all. They bought a 170 call and they sold a 197.50. Okay, so once the stock hits 197.50, these two will both increase the same dollar for dollar. So this will go up in value $1 at a time. This will go down in value $1 at a time. So we are capped at 197.50. The stock's at 195. So we paid a lot of money for it in the money 170 with the max ability to make money of less than $2.50. So, okay, I mean, I think I'll stop harping on it, but I hope you're understanding what I'm saying. Overall, net assets, $663 million. I just sum up the total of the underlyings because with this 566, that helps me run all these formulas for weightings. Okay, there was an increase again on Friday for the shares of 5 million. So that comes to 107 million outstanding shares. The NAV and the closing price are within a few cents of each other. And I just wanted to mention, since we're in our long form video, week look ahead, I do not consider the buying and selling of the stocks in the options trading profit and loss. I need to have an interview before I can figure out how they do this, but let me just give you my reasoning why. When somebody buys into the fund, like say these 5 million people, call it $6 stock price, that's $30 million gets brought in, handed to them to invest. If they turn around and spend it and they buy $30 million worth of shares, that would look like a negative, right? Buy, negative. That would look like a negative $30 million day. Right? And it wasn't. It wasn't a loss at all. It wasn't a profit. It wasn't anything. More money got put to work. So we're not calling that a loss, or else we would never have a winning week. We would just have huge losses every week, which is not the case. So then my thought process is, well, if I'm not going to count the purchasing of stocks, then I'm not going to count the selling of stocks either, because there's times where we sold like $40-50 million worth of stocks, and that's not an options trading profit or loss. Now, the right answer might be, well, would they buy it for, don't count the buys as wins, or as losses, don't count the sells as wins, but you got to count the profit in between. Well, some of these stocks have been in here for forever, so we're going to just keep on holding track of it forever, and then one day when they sell it, try to do the math. So that's why I don't count the buying and selling of shares themselves as profit and loss for trading options. I just count the options. Okay, Same thing goes with LFGY. That's where we will move to next. I hope you got all the information for Ulti that you're looking for. Next, LFGY, we'll start with the guesstimate again with the trading wins and losses and the share value. Not quite as many trades. Let's see. We started at 1,025 for the line, and we go to 1248. So about 223 trades throughout the week. All right, we take a look at the trading week. They lost 190,000 on Monday, 500,000 on Tuesday, 900,000 on Wednesday, 2.6 million on Thursday, and they made 124,000 on Friday. If you're watching this and you're getting stressed out, you're probably going, every week he says we're losing the trades. How are we getting paid out? Well, the reason is because they're increasing in value. So I just want you to think about this for me. If they weren't paying out a distribution, so think when you pay out a distribution, let's say it's $1 just to make it real easy, and LFGY was at 40 on X day, it opens at 39. So if they were just doing this every week but paying out no distribution, well then there's no days where it's not dropping by the distribution every week, and it just keeps on climbing and climbing and climbing because they keep on increasing in share value, right? Because the stocks are going up faster than anticipated. That's causing us to lose the options trades, but we are gaining value. And I've showed you each time the amount we lose on the option trade is less than the amount we gain on the share value increase. Now, one's realized, the option trade, the other is not, but our share value, our price of LFGY or Ulti would be well above where it is now, the $6 and the $40 range, because it would just keep on climbing from all these increases. And if you like that, you say, hey, they should do that, then you should be in a growth fund. This is not a growth fund. These are option income strategy funds. They are about income. They are about paying you out a weekly distribution that you can count on. So if that's what you like, you're in the right one. If you say, hey, no, keep the money and make it grow, go to a growth fund. This isn't the one for you. So I hope that helps explain to people how this is working. We're losing the trades because the shares are going up too fast, too much. So this week, no different. Lost almost $4 million trading. That comes out to over $1.10 per share loss. So they are not going to divide that out among the 3,575,000 shares. So the next thing we do is we take the IV, 30-day IV estimate, 30-day IV, weighted average, 60.15%. We multiply it by the closing price on Friday. We have learned from interviews that they stop considering everything at the close of business on Friday. So even though they don't declare till Wednesday, Monday and Tuesday are going towards the following week. So we multiply those two. That gives us a number. We divide it by 52 because this is a weekly paying fund. So there's 52 weeks in a year. It comes out to 46.21 cents per share. So then I go through, I take a look at, past distributions, what they've been paying recently, 48, 46, 47, 46, 49. All right, I can kind of compare it with the information I had on how they did those weeks, how much they lost trading, how much they made in share value, right? I keep all that. I just hide it to make this easier. Oh, I clicked the wrong button. I said hide, but I need to unhide it to show it to you. All right, so I keep all of those each time, kind of make a comparison. But at the same time, you come here for the information. The guesstimate's just bonus, right? So I don't claim to be right all the time. I'm usually within 5% though, so that's not terrible. All right, so let's add that. So that's how I came up with this, and I came up with 48 cents. It's just a guess, so take it for what it's worth. All right, so that's our guess. I think you're going to get, 46 is the minimum. 48 is, I think it'll bump it up to 48. Hey, it could be even more, maybe 50. But all right, let's take a look at how we're doing. Let's hit this first while it's right here, right? $142 million being managed in the fund. I already said a little over 3.5 million outstanding shares. There's a decent gap between our NAV and our price at closing, which is not very normal. It usually within a few cents, but 19 cents for now. So you were paying a little bit of a premium if you bought at the close on Friday, compared to what it was actually worth. Okay, let's go through and look at some now where Ulti is very, I would call it almost evenly allocated, right? They run in a very narrow range, maybe a little under 3% to high 5%, everything. These, you've got some in the 1% range, you've got some in the almost 16% range. So this is not an evenly allocated, right? They are heavier on certain things as compared to others, like Coinbase, for example. But so let's see what we've got a lot of. Coinbase, 15.7%. IBIT, iShares Bitcoin Trust ETF, 9%. 10% in MicroStrategy. So those are three, those three combined for over 30% of the, maybe even 35% of what's in here. Now when we go through IVs, we got some nice ones here, right? 95.5% with BitDeer, 122.5% with Core Scientific, 94% on Galaxy, Hut 8 Corp, 84.5%. That's not bad. Then we get some low ones. We got some 30s. So all in all, when we take those, average them out, 60.15%. Okay, now let's take a look at where our options are sold for the upcoming week or weeks and see how that compares in the money, out of the money. So BitDeer, they went ahead and skipped next week. They just said, let's go out to the 11th. 11.50 is the strike price. 11.09 is where it closed. So that's 3.7% out of the money. CleanSpark, they stuck with this coming week. $11. Stock's at 10.67, so that's 3% out of the money. Coinbase, they gave themselves some space. It's this week, so it's only 3.5 trading days. They chose 390. That's 10.3% out of the money. Core Scientific, this one's scary, right? We just talked about this is our highest IV. Got the potential to move the most, and we are starting the week in the money 1%. So we can't have this stock go up at all this week. We actually need it to come down. Not a great situation to be in, but maybe they know something we don't, and it's going to come down. 17.50 is the other strike price, and those are 5% out of the money. I sat there and gave all that talk. There's only 128 contracts that are in the money. 5,600 contracts are 5% out of the money. So not so much of a big deal. This one doesn't have nearly the impact that I made it out to be, right? You can see this one, 19,000 compared to 650,000. So sorry for the scare tactics. Okay, Galaxy Digital, $20.50. Let me take a step back just in case you're new here. Ulti and LFGY trade a different option strategy. Ulti trades what's called a collar strategy, with the exception of those couple of debit call spreads that were new in the money. LFGY does not. Sometimes they will, so they own the shares. Sometimes they will just sell a call, as you can see right here with Robinhood. Other times they will sell a call and then buy a call further out. That would be a credit call spread. They collect the money from the closer one. They protect themselves in case the stock continues to go higher with the further out of the money one, so that limits the amount they could lose on having to pay to close. On none of them, though, do they purchase puts in order to protect for the downside. So LFGY is more exposed to NAV erosion if these stocks drop, because there's nothing that gains in value if the stocks drop to offset it. So just take that for what it's worth. Help you make your investment decisions as far as risk is concerned. Okay, Galaxy. They've got their call sold at $20.50. Those are 2.65% out of the money. They are for this week. GameStop, also for this week, has 24.50s, and then for next week they have 25s. They're 3.8 and just about 6% out of the money. Robinhood, just a standalone, just sold the call. $90 for this week. That's 8.3% out of the money. Hut 8 Corp, $18.50 for next week. You can see that 7-11. That's 4.76% out of the money. IBIT, they don't sell options off of it, so this one could go through the roof. We want IBIT to go to $1,000. There's nothing limiting what we can make on that, but we're also not collecting any premium. Mara Holdings, they have $16 selected for not this week, but the one after that. 6.5% out of the money with the stock at just over 15. Now MBTX, similar to some of those new strategies over on the other side, it's not new over here. They don't own the shares. They just have some spreads on it, but their spreads are even a little different. So they have a credit call spread similar to the rest of the things in this fund, 260, 285. So they sold the 260. It's 2.8% out of the money. So we want the stock to stay under 260 to keep all that premium we collected. Now, they also have a December, and that's for July 18th. They have a December 31st debit put spread. So that means they purchased this, the 230. They sold the 150 to help finance it, and they need the stock to drop below 230 in order to make a profit here. So we'll keep an eye on this one here. We want that to go into the positive in order for this trade to win. Positive as far as this option right here. We want it to go in the money. Okay, Mercado Libre, they've got 2610 selected for the third. That's less than 2% out of the money there. MicroStrategy, they evenly split at 183 and 182 for the 11th. I'm sorry, that's the contracts, 183 and 182. 410 and 412.50. They're 6.8 and 7.4% out of the money. NU Holdings, right? There's no protection for this. It's not a spread. It's just a sold call. Now, if you were doing this yourself, you just sell that call, you collect the premium, and if it runs above it, you just let your shares get called away. But they don't let their shares get called away. They will buy to close it, even if they have to take a loss. But they're for July 3rd, 5.6% out of the money. NVIDIA, they've got a credit call spread. The July 3rd, 155 is the strike price. The stock closed at 157.75. So these are starting the week. We need to make it to the midday of Thursday and lose 1.74% in order to not lose this trade. So that's an odd situation. Basically, what you're going to see is if the stock starts moving up early in the week, they're going to roll this, and they're just going to take the loss. Opera, July 18th. I don't think there's as many options available. I don't think Opera has weekly options. I could be wrong, but they seem to always be trading further out. So that's the monthly there, July 18th, 20. They're 8.2% out of the money, but we don't have to worry about them for the next 2 weeks, really, because it's the third week before they expire. PayPal, July 3rd, 75. That's 1.85% out of the money. Riot Platforms, they've got 11s and 1150s, all for this coming week. Really, the 1150s, what's important, 5,900 contracts compared to 181. They're 4.2 and 9% out of the money. Tesla, they've selected 340. Let's see real quick what got selected over here on Ulti. I wonder if they talk. That's another question. I'll write it down afterwards. Hey, look at that. They selected 342, 340 and 335. I wonder if the same traders work on different funds or if they talk with each other. So that'll be one of my questions. 5% out of the money for Tesla's calls. And finally, Block or XYZ, July 3rd, 68, 2% out of the money. Okay, so now after watching this, you've got an idea of where you want all the stocks and funds within the funds to trade in order for us to make the most money. So the goal would be a slow climb towards those strike prices without going over it. That way we increase in share value and we don't run past to the point where we have to pay to close things out. We get to keep the premium and increase in value. That's that'd be the best best case situation, but obviously we don't really expect things to work out perfect for us like that. So, okay, we've got our guesstimates. We've got our week look ahead. So the only thing you got left to do is finish enjoying the rest of your weekend. Got the dad joke of the day for you. So before you do, thanks for watching. I appreciate it. Appreciate all the comments. Appreciate all the help from Health and Wealth and from Retire on Dividends, guys mentioning me in their videos, sending people my way. It really helps a lot. They have helped me hit my goal in 2 months of 1,000 subscribers. So you guys are awesome. Okay, dad joke of the day. I used to run a dating site for chickens, but I was struggling to make hens meet. It's pretty good. And I have chickens, so that makes it even better. So yeah, I'm into other kinds of investing too, man. There's things lay gold in my backyard while you guys are paying all that money at the grocery store. No, it's definitely not profitable. I think at best you break even. But anyway, thank you for watching. Have a good rest of your weekend and good luck trading this coming week. I'll talk to you on Monday.